We're starting the week with Gary Wagner and Chart This next. Gary, thanks so much for being with us.
My pleasure as always. How are you today, Daniela?
Fantastic, Gary. And we're gearing up for the end of August here. Are traders getting ready to go back to school?
Well, I certainly think that we're probably getting near the tail end of summer, and traders are starting to head back into the office as summer break is over. So I would look for that over the next couple of weeks, absolutely.
So before we look ahead now, Gary, just want to get your thoughts quickly on that news item we saw last week, and that was in regards to John Paulson reducing his holdings by 53% in the Spider Gold Trust. He did this back in June. So A, is that the reason we saw that correction in June? And B, are you really concerned by this news?
Well, first of all, it absolutely could have had an influence on the recent correction that we witnessed in terms of the depth of the correction. I think the correction with or without this gentleman was going to happen, but the amount of equities, in other words, gold stock that he unloaded, is going to add pressure to the market.
Gary, last week when we spoke, you were optimistic gold could hit 1,400. Are you sticking to that?
Absolutely. When I said, I should have said added pressure to the market, as in past tense. Right now, I think that we are back in what's called an impulse phase, which is a bullish level of the market. Now, realize that even in a impulse phase, the market, as it moves to higher prices, stair steps. In other words, it goes, 3 steps forward, 2 steps back, 2 steps forward, 1 step back. So it stair steps up. And I think that that's what we're witnessing since the low that we hit at about 1181 or below 1200.
Sorry, Gary, you called it an impulse phase?
An impulse phase comes from Elliott wave, and simply what it looks at is a cycle or a pattern that markets tend to follow, whether they're a bullish market or a bearish market. In a bullish market, it doesn't tend to go straight up. It's stair steps. So there's a series of 5 waves, and that's called the impulse phase.
Gary, let's also talk about how silver has been outperforming gold on the back of Chinese demand, but we know there's no shortage of silver out there. So do you think these moves we have seen are exaggerated and we could see a pullback?
Well, the two-part question. First of all, do I think that the moves have been exaggerated? It is a marketplace that has a lot less volume than gold. It is a thinner market, so that larger players are really able to move the market easier than they could with gold. Do I think it's headed back down? I think that we're going to see extremely volatile swings in silver, but I think it's going to follow suit with gold. What I found amazing last week was that as the equities markets came under pressure, and of course silver is heavily used in industry, rather than it reacting bearishly, it continued to rise. And in fact, we had 2 days last week where we had 4% and 5% daily gains. Incredible.
So are you saying it's best to be long silver now, Gary?
We are long silver, yes.
Gary, we'll get to your insert now. What have you brought us this week?
Well, what we're going to be looking at this week is a very, very long-term and then a very, very short-term look at the market. The long-term look is we're going to be comparing recent rallies to rallies that happened quite some time ago. And then secondly, we're going to continue on with the insert that we had last week, where we're looking to forecast and using an Elliott wave and a Fibonacci model to actually analyze where we think the upper level of gold could be over the next, say, 4 weeks now.
Let's get to that right now, Gary.
If you recall from last week, we talked about the fact that we could be at a moment in time that's absolutely exciting when it comes to the gold market. In other words, we were looking for the market to have a major breakout. We got that over the last week. But what's more important is what that's telling us in the long term, because it's given us technical evidence that in fact this long correction we have weathered through from 1900 down to 1181 is over. We've gotten a first piece of technical evidence, and I do want to talk to you about that. But before we do that, I want to kind of take a broad view of the market, and to do that I'm going to pull up this chart here. And in essence, what we're looking at when we look at this chart is the move from roughly 2003 in gold up to the present. And as you can see, we've basically divided this into two major rallies. And the rallies that we're looking at are as follows. We start from roughly $300, and our first rally takes us all the way up to this top, and this top here is just above $1,000, and the correction down roughly $700. This is our first rally. And then the second major rally is from roughly $700 up to $1,900, or the record top, and then the correction that followed. Now, what is interesting is I've put one Fibonacci extension into this particular chart. And the extension that I'm using is we're starting right here at 300 as our bottom. Our top is the end of this tremendous rally right here. So from here to here. And then what I've done is I've done an extension. You can see the extension right here. This is the fib extension of that particular move. It starts from, of course, the beginning, the bottom, or the beginning of our count one here, or the bottom of C. When we do that and we look at the extension, we take 161%, and that is telling us that based upon this particular rally, if the rally is a more powerful rally at 161%, this is 100% here, but at 161%, it is forecasting that the top of this will be somewhere around 1900. And as you can see, it hit that top precisely. We can take the two rallies that I just spoke about, meaning our rally from 300 here and down, and our next rally to our record top and correction here, can really all be seen or subdivided into an Elliott wave count. And that's what I'm pulling up for us now. And as you can see, in terms of this last rally, and that is of course the most important thing and what counts, we then can subdivide that into our current Elliott wave count, which looks something like this. 1, 2, 3, 4, and 5. Those are our impulse waves that take us to this record top at 1920. Our correction is a protracted ABC, and the reason that that is so important is because if in fact this market is headed up, we have just started a brand new impulse phase, just like in here. This insert is being filmed or recorded on Sunday in Hawaii, which means it is Monday in Australia, and the gold market has just opened up for the week. As you can see, it has opened up higher. 1378 and change is our current print that we're getting. And I am looking for this market to move substantially higher. In terms of where I think we will find certain resistance in the marketplace, our key point right now is really just at about 1400. And you can see that 1400 on a psychological level is just where the market was prior to it falling from grace right in here. You can see that the market was trading sideways for some time, and this was just prior to our major drop down. Now, from our major drop down, it is my belief and contention that that concluded the end of our C wave, our long correction down, and it is my sense right now that we have begun an impulse phase. And as we've talked about over the last couple of weeks, now the subcount that I'm looking at right now is all a part of a what's called an intermediate one. And in the intermediate one, that's going to be composed of these subwaves as follows. We have wave 1 here, 2, and I believe we're currently in wave 3. These can of course be divided, wave 1 into 1, 2, 3, 4, and 5. Same thing with our 2. And as I said, I currently believe that we are in wave 3 right in here. Now, as you can see, what I have done is I have added a Fibonacci extension, and the Fib extension really covers wave 1, and then we extend wave 1 to the bottom of wave 2 here, and then we draw our assessment. If wave 1 and wave 3 are simply equal, that would put my forecast for the conclusion of wave 3 somewhere around 1437 per ounce. And that is pretty exciting news, especially for us gold bulls. Now, when we take a look at this chart, and this is a weekly chart, but this has our current count, just to kind of put it into perspective, what we're looking at is our entire impulse phase, 1 through 5, is here. I believe that our entire corrective phase, ABC, is here. And I believe that what we've just started now is another impulse cycle. You'll get your count 1, 2, 3, 4, 5, your correction A, B, C, A, B, and then C. And if conditions are right, in other words, if we're still within a bullish market, that cycle will simply repeat itself as it did here to repeat itself here. My belief is that we are again into an impulse cycle. I have some forecasts and some models which are projecting where this impulse cycle should take us, and I do want to share that with you. Time permitting, though, what I have decided to do is, because we have had such a great and loyal following on Chart This, I'm going to be doing a short production called Chart This after the show. And what that will do is it will allow you to get my forecast up to the minute and with the most latest data as it has come into us. Now, for those of you who want to view Chart This after the show, simply go to our website, goldforecast.com, scroll down to the bottom of the screen, and you'll see this small copyright. If you go ahead and click that copyright, that will take you to the Kitco bonus content page and Chart This after the show. Again, Fibonacci retracement, Elliott wave, Fibonacci, and candlesticks as it pertains to current gold pricing.
Thanks for that, Gary. And before I let you go, do you have final thoughts for investors as we start off this week?
Well, I think that we want to watch what the Fed is doing because we have a lot, the minutes being released. But I think that right now we've got a clear path, and we want to also see what's going on in Egypt, because my sense is we are kind of building different variables that might kind of coalesce into the perfect storm, and if that happens, we could really see a spike in the precious metals markets.
Gary, thanks so much. It's appreciated. We'll see you next week.
My pleasure as always. I look forward to seeing you next week. Have a great week.
And thanks for watching this edition of Chart This. You can email us at newsfeedback@kitco.com or follow me on Twitter @Daniela Camboni. Thanks for watching.